G'day members, my name is Mitchell Sneddon and I'm joined here today by Portfolio Manager for BKI Investment Company, Tom Millner.
Hi Mitchell, how are you?
Good, Tom, how are you doing?
Good, thanks for having me.
Now, Tom, this morning you released your half-year numbers to the market. The main number I'd say a lot of people will be asking you about is your performance, your returns. Now, on the one-year numbers where total shareholder return is around 2.6%, compare that to the market of 13.4%, slight discrepancy. Explain that to us.
Yeah, it was a bit, obviously as a portfolio manager it's disappointing to see those numbers, but it's pretty easily explained when you look into it. There's a few factors. Mainly, we are underweight REITs and we're underweight resources. Both sectors have done quite well for the last 12 months. The resource index in particular, I think, is up 40-odd%. Big driver of that's been BHP and Rio. But we can't play in that space. Given what BKI are trying to do in forming a consistent revenue basis to our shareholders, 26% of that resource index doesn't pay a dividend, and the total yield of that index is about 1.7%. So it's very low, it's very unattractive from an income point of view. In times like this, when that part of the market outperforms, we will underperform. So that's one reason. The second reason, as I said, was the REITs. I think we're about 7% underweight the REITs. They've done very well. And the third reason, in a total shareholder return point of view, is this time 12 months ago we were trading a 10% premium to NTA, which is a little bit crazy in a lot of people's minds. So we're recycling that gap, if you like. So the 2.5% return versus 13% for the index is made up of those main factors. And
that's something that's really key to LIC investors, isn't it? You really do have to focus on that discounted premium to NTA, and even as good as, say, a listed investment company may be and you want to get in there, paying too much, you may as well be, say, buying the index, and that's a pretty good example.
That's exactly right. We don't ever encourage people to sell at the premium because you've got tax issues and liquidity issues and that sort of thing, but it's a very difficult time to buy an LIC when they're trading at sort of 10, 15, 20% premium to NTA. And that there are times, as you said, that in cycles you can pick them up at parity or at even discounts.
Now, looking at the numbers as well, the 3-year numbers are just a shade below. Yeah. Is that a reflection of what we've seen in the last 12 to 18 months as well?
The last 12 months has been a big drag on 3-year numbers, exactly. I suppose the other thing to add in the resource exposure is our holding in New Hope. Thermal coal prices have done exceptionally well. The dollar's come back to sort of 71, 72 cents. That hasn't been reflected yet in the New Hope share price, so that's also lagged our number a little bit. But the 3-year number, New Hope, but also resources the last 12 months has been a big drag.
Speaking of the dollar, you've got a few companies in the portfolio that have offshore exposures. What is your longer-term view on the Australian dollar? Yeah,
we think as the US economy improves and inflationary issues force the Fed to put their rates up, that'll encourage people to buy the greenback, and the US dollar will appreciate, and as a result our currency will depreciate, and we think it will continue to trend downward over the medium to longer term. Can't give you a number, it's always hard to forecast the dollar, but we think that the trend of the last 6 weeks in particular will continue over at least the medium term. We're hoping so anyway.
Now, going back to the exposures within the portfolio, if first look at it, obvious standout is the banks. About 30-odd% of the portfolio is banks. Yep. Give us your 10-year view, say, on the banks, because it's been 25-odd years since we've had a recession. The longer that goes on, the potentially closer it is to us actually having one. And the banks are very highly leveraged instruments. So a tick up in bad debt and bad loans can spell trouble for them. But clearly, that's not something that is in view at the moment.
Yeah, we've now got the top 4 stocks in BKI are the major banks, which is something we've worked hard on not promoting before. We've been underweight ANZ because we didn't like the Asian strategy and the risks around that. We're seeing that unwind now from the bank, not from our perspective, but from the bank. So all of a sudden the share price of ANZ's appreciated and the weighting's increased substantially in BKI. So we've got the top 4 stocks are the majors which leads to questions like yourselves and leads to questions from our investors who have probably got those banks as well. Why should I own the LICs? Because they've got a big exposure to banks. Well, to give you an example, we've got about 31.5% exposure to the banks, and they account for about 45 to 47% of our income. So the yield's still very, very good. So to your question, how does that growth and that income continue? I think the Basel III and Basel IV requirements on capital requirements is something that protects not just the clients of the bank and the bank itself, but also protects shareholders, because you've got less risk in the bank as you would have had probably 5 or 10 years ago when we went through the GFC, for example. I think if we went through the next GFC, the banks are going to do significantly better than they did in 2008, 2009. The return on equity component, because you've got so much cash in your balance sheet, is struggling and will probably no longer be 15, 16%, but probably more like 13, 14%. It's just something that the market has to live with. But the protection of the stronger balance sheet and the stronger business model, I think, will outweigh that. Housing is interesting. The thing that worries us, and we've got a very astute director on our board, Mr. Ian Huntley, and he's been around for a long time, as has my father, Rob, and they talk about this 7 to 8 year cycle, and we're well and truly in that cycle. One thing we've been discussing at the BKI board in particular is the housing bubble going to be the thing that upsets the apple cart and impacts the bank's earnings? And I think the way that they're doing their own independent rates and variable rates, fixed rates now, I even saw from NAB yesterday, it's sort of taken out the cash rate, I think. So they're a bit more independent than they ever used to be, which is quite good and protective of shareholders in that sense, and even the borrower. But I think also if you go right down and look at how many actual people have got mortgages, how advanced they are in payments, the bit that does worry us is more of the shadow banking sector and what knock-on effect that will have to the majors. But we are still comfortable with the banks, their housing exposure, their funds management, their wealth, and their loan books as well. We're still pretty comfortable with that.
So moving on to another position in the portfolio, TPG. It's been a fairly topical one over the last few months. A bit of pain felt to the portfolio.
Lots of pain.
There. Now we at Intelligent Investor and InvestSMART, within our model portfolios that we run, especially the Intelligent Investor Growth portfolio, we bought into TPG after the drop, and it's done quite well for us since. We bought into it with the view that the Singapore expansion is something that's not to be afraid of, which is probably not the experience of Australian investors in the past with other people's expansions into Asia. Given your relationship with Solpats, who owns quite a significant stake in TPG, and it's in your portfolio, what's your view on the Asian expansion, and what does it mean for the business?
I think it's a good segue into the Asian market. I think the Singaporean market is a very mature, stable environment to do business in, and Sols has got a good history of doing business throughout Asia, and in particular in Singapore for many years, whether it be through coal mines or pharmaceuticals. So it's no stranger to us, the Singapore market. I think the price they paid for the spectrum is very attractive, so they've got a good leadway into the business. It's very competitive, but there's upside on attacking the pricing componentry for the customer there. So we're pretty comfortable. It's not a huge investment, but I think that talking to the TPG guys, they're very confident on putting that piece together in the whole portfolio. But you're right on the pain segment. It's been a very difficult 6 to 12 months. But I think like a lot of small to mid cap stocks, that they're overvalued to start with. We've seen a lot of stocks in the market trading on 20, 30 times that they can't sustain that growth. 7 to 10% EPS growth in this environment that TPGs will probably produce is still pretty attractive. The dividend grew, I think, 20% last year. So it's still fundamentally a really good business. Domestically, the competition's drying up. There's two main players really now in that space, and they're doing well. But to hear you guys buying when I think you probably did was a good move in my view.
Did you guys top up as well, or?
No, we didn't, and the only reason we didn't is because I think Sol's exposure is about 44%, so we've got a big swag of stock there, and the position in BKI for memory is about 2.6%, 2.8%. So that and Telstra we own, a big swag of the shares, and at one point I think it was 11% of the portfolio. We owned about 5% in each stock, so it was a big weighting anyway. So, but we're there for the long term, and hopefully the growth rate continues.
Now, moving on to the other big change for BKI in the last year was the formation of Contact Asset Management, which is part owned by yourself, your offsider Will Colbert, and Sol Pats as well. Now, that you externalised the management of BKI to Contact Asset Management. Tell us the thought process behind it. I could imagine there might have been a fair few skeptics out there, and you have to put your cynic hat on when you see the internal management go to an external, because that typically means bumping up the management fees, etc. So the manager is benefiting, and that carpet, as you guys continue to say, might get thicker.
Yeah.
And therefore the dividend thinner.
It's a great question, and it was a big move because you're right. We went against the grain. A lot of external managed LICs traditionally go internal, and that's what happened to BKI. We had an external agreement at IPO, and when that expired, I became CEO, and we internalised management at BKI. What we wanted to do at BKI was lock in the MER. We didn't want to grow BKI and then have to fund it with extra staff members and costs. So we locked in a 10 basis point management fee to Contact, which is pretty low industry standard wise. It's probably one of the lowest management fees around. And our MER at the half was 14 bips. I think Milton's MER is 12 or 13. I think Carlton's is about 9 or 10. So we're the third lowest probably managed product in the whole market, I think. So we definitely haven't done what the skeptics would say by increasing fund flow to the manager. It's gone the other way, which is interesting, and you're probably right. It had to have a bit of explanation, because I think people just assume that the fund managers are going to come and grab all these fees off us. So we had BKI shareholders first and foremost in our mindset. So
what does Contact Asset Management mean for the BKI shareholders? What benefit are they going to get out of it? And one thing is, you touched on it, say employing another analyst or another two analysts or three into BKI would bump up that MER, but of course then Contact can take on that expense.
Yeah, that's exactly right. So what we're going to do is we're going to put employees in Contact Asset Management. So we've set the fixed cost at BKI. BKI now won't have to pay directly for those extra employees. And as we roll out new LICs under the Contact banner, we will put more staff on. And as a result, the resources to the Sols, BKI and other LICs that we do will increase as well. Sols owns 20% of Contact. Will Colbert owns 40%. I own 40%. So we'll benefit the group by increasing the bulk of resource staff in Contact.
Now, speaking of increasing the bulk of resource staff in Contact, one issue that I've been rolling around in my mind were yourself and Will spreading yourself too thin. Given you're looking after a portfolio of close to $1 billion, you're setting up Contact, the portfolio positions, you've got maybe anywhere from 30 to 40 stocks in there. And then plus you're also getting out road showing BKI to keep that NTA gap nice and tight. Yep. Were you spreading yourself too thin? Did you need those extra
I think
staff?
we did. I think we got to the stage where we needed to put at least one more employee on. But as you know, if you put a good analyst on, it's going to cost you 150, 200 grand for a top line analyst or portfolio manager. And if we did that at BKI, the MER would have gone to sort of 25 basis points. So you benefit by bulking the team, but it costs more to the company, and it puts pressure then on performance and all the rest of it. So we were very mindful of that. We've got some very loyal shareholders at BKI. I want to protect that stream as well. So we will bolster the contact thing. The other thing, I suppose, that will benefit the BKI shareholders is access to other products in the market, access to other ideas, as Will and I and other analysts get out more into the field, as we do now, but we'll do it more. The information flow that gets down to the BKI share portfolio will increase as well.
Well, speaking of that, I did happen to see an article in the Fin Review not too long ago. It mentioned a new LIC by the name of URB with an urban renewal theme.
Correct.
Can you tell us a bit about that, and when can shareholders expect to see a prospectus out?
Sure. So we're in the throes of putting together URB investments, which is, as you said, investing in the urban renewal and regeneration thematic, which is a huge tailwind in Australia. Major cities, but mainly in Sydney at the moment, given the huge government spend on infrastructure, roads and rail. We're sort of putting the last pieces together on that product at the moment. We should be in a position to be able to do a roadshow mid-February with the prospectus to be lodged sort of second week, third week of Feb. BKI shareholders, sole shareholders will be probably getting a priority offer. And it's another opportunity to bring further different product to the shareholder base of BKI.
And within URB, we'll be expecting to see something slightly different for you guys: direct property exposure in there, as well as the your transurbans, etc., that have been mentioned.
That's exactly right. So it's going to be a bit different. We are going to have the opportunity to co-invest at the direct property level with Soul Patts, which is something that I don't think has ever been done before. So that's very attractive and exciting for us to be able to offer URB shareholders that opportunity. The other interesting thing is when you narrow the universe down to have stocks that just look at urban renewal thematic, we've created our own universe that's very appealing and got a great tailwind of earnings growth for the next 20, 30 years. This story is intergenerational, and it's a really exciting time to become a listed company in that space, I think. So.
And this just came to me now, it's interesting that you mentioned you were underweight property in BKI. But
and that's the best thing about this other LIC. If we do it properly, it shouldn't have any banking and resource exposure, but it will have property. And BKI's exposure to property is about 70 basis points only. So it'll complement the BKI portfolio quite nicely.
With interest rates potentially set to increase, is it the right time to be looking at property?
There are parts of the property market that are still attractive. Gentrification of suburbs and town centres on the back of this infrastructure spend is still quite significant. I think the beauty of having an open mandated URB as well doesn't pigeonhole you into an industrial property manager or commercial or office. We can do what we do at Souls and even at BKI, be very, very diversified and pick the points of the cycle and parts of the market that people are sort of shying away from, if you like. So that opportunity is also pretty exciting.
Okay, so something to keep an eye out for mid-February.
A bit early to talk about maybe much more on it now, but the prospectus hopefully be sort of mid to late Feb.
Great, we'll leave it there for now, Tom, but thanks for joining us.
Thanks for having me.
No worries. And members, thank you for joining us, and we'll catch you next time.
So as a near retiree, if I had a fairly limited budget looking for conservative returns, I think I'd probably look towards more some of the InvestSMART balanced income and growth portfolios, because I feel they are much more broadly based. They're much closer to the overall index. I'm looking for Intelligent Investor as maybe Ferrari is the wrong word, but for me it's that part of my portfolio that really is seeking the higher returns. I'm expecting it to outperform at times, and certainly the outperformance recently has been, really quite extraordinary.